Hey everyone, welcome back to Entrepreneurial Edge. Today we're talking about Warren Buffett, the Oracle of Omaha himself. As of 2024, he's sitting on a cool $135 billion. We're going to dissect one of his core strategies, using dividends to create long-term sustainable wealth. And if you stick around, I'm going to share how Buffett strategically chooses his investments for maximum dividend payouts. Make sure you hit that like button and subscribe so you don't miss out on future breakdowns. Now, before we dive into dividends, we have to understand the foundation of Buffett's investment philosophy, value investing. This isn't about chasing the next hot stock tip or trying to time the market. It's about identifying companies that are undervalued, businesses with strong fundamentals trading below what they're actually worth. Think of it like finding a hidden gem at a garage sale. Buffett digs deep, analyzing a company's financial health, its earnings history, its management team, and its competitive edge. He looks for companies with a proven track record of profitability and, crucially, a history of paying dividends. Dividends are like a bonus for owning a piece of a profitable company. Think of dividends as your passive income stream in the stock market. It's like getting paid rent on a property, except you don't have to deal with tenants. These regular payouts provide a consistent income stream without you having to sell your shares. When you reinvest those dividends, you're buying more shares, which generate even more dividends, creating a snowball effect that can supercharge your returns over time. Buffett isn't looking for quick flips or overnight riches. He's playing the long game, letting those dividends compound over decades, building wealth steadily and sustainably. Now, not all dividends are created equal. Buffett is incredibly selective about the industries he invests in. He steers clear of sectors prone to hype cycles, volatility, and uncertainty. Instead, he gravitates towards stable, cash-flow-rich industries that have stood the test of time. Think consumer staples, things people need and use every single day, regardless of the economy. This isn't just about avoiding losses. It's about aligning your investments with companies that can consistently generate the profits needed to pay out those juicy dividends. Let's talk about this Coca-Cola deal, because it's a perfect example of Buffett's strategy in action. Back in 1988, he poured a cool $1 billion into Coca-Cola stock, acquiring a sizable chunk of the company, about 6.3% ownership. At the time, Coca-Cola's annual dividend was 22 cents per share. Fast forward to 2023, and that dividend has skyrocketed to $1.76 per share. Buffett's annual dividend income from Coca-Cola alone is now a staggering $704 million. This is the power of long-term thinking, picking solid companies, and letting those dividends compound over time. Now, you might think of Buffett as old school, hesitant to embrace technology, but he surprised everyone when he dove headfirst into Apple. Initially, he wasn't sold on tech stocks, but after analyzing Apple's business model, its brand loyalty, and its incredible cash flow, he changed his tune. Since 2016, his company, Berkshire Hathaway, has been steadily accumulating Apple stock, amassing a massive position of over 900 million shares. Apple's dividend payout in 2023 was 23 cents per share. This move shows that Buffett is willing to adapt and evolve his investment strategy. Buffett has even gone on record calling Apple the best business we own. He's impressed by their brand loyalty, pointing out that people are more likely to give up their second car than their iPhone. This unwavering customer base translates into predictable revenue streams and, you guessed it, consistent dividend payouts. Buffett understands that in today's market, a company's brand and its connection with consumers can be just as valuable as its physical assets. This is why Apple stands out as a top investment. Now, you might be wondering, if Buffett loves dividends so much, why doesn't his own company, Berkshire Hathaway, pay them out? Here's the thing. Buffett believes that he can generate higher returns by reinvesting all of Berkshire's earnings back into the company and other promising investments. He's essentially compounding those profits within the company itself. He argues that holding on to that cash allows him to capitalize on new opportunities and grow the business at a faster rate than if they were to pay out dividends. However, he has acknowledged that at some point, when reinvestment opportunities become scarcer, Berkshire Hathaway will likely start paying dividends to its shareholders. So, what are the key takeaways here? What can we learn from Buffett's dividend-focused strategy? First and foremost, focus on buying and holding great businesses for the long haul. Remember, time is your greatest ally in the market. Second, reinvest those dividends. Don't underestimate the power of compounding to supercharge your returns over time. Third, tune out the noise and avoid market speculation. Focus on the fundamentals: a company's earnings, its cash flow, and its long-term prospects. Finally, if you're not comfortable picking individual stocks, consider investing in a low-cost S&P 500 index fund. Buffett's strategy proves that when you combine the power of dividends with a long-term investment horizon, you create a recipe for exponential wealth growth. It's not about getting rich quick, it's about building lasting wealth over time. Thanks for joining me on Entrepreneurial Edge. Don't forget to give this video a thumbs up and subscribe for more insights on building wealth and achieving financial freedom. If you want a deeper dive into any point, let me know in the comments below.